Family office money associated, I mean, no small change. You're talking about $2.2 billion. I mean, in an environment where interest rates are rising, there's high inflation, are family offices rethinking how they're allocating their assets?
Absolutely. This is a challenging environment for many of these family offices. Given rising interest rate, high inflation, and central bank tightening, many of these family offices are forced to review their strategic asset allocation. And we have seen them reducing exposure to fixed income and moving a lot of that money to alternatives, whether it's private equity, real estate, private debt, and hedge funds as well.
Are they keeping pace with this substantial transformation we're seeing on ESG as well? Because coupled with this shift in macro factors, there's also the shift with ESG, sustainable investing. Are they falling in line with that trend?
Very much so, especially here in Asia Pacific, because a lot of the economy is natural resource based. So people are very familiar with the sustainable investment topic or the ESG topic. If you look at the Asia Pacific family offices, more than half of them have already made investment in ESG area, and they will continue to step up. But I think they're also becoming a lot more selective in order to avoid the greenwashing concerns.
So, Tommy, let me ask you, I mean, these family offices, some of them are huge, right, in terms of funds, and sometimes they're run by outsiders, by professionals. Sometimes I think the family actually dabbles and tries to have a hand in it as well. But when we're talking about this kind of money, traditionally it's been pretty conservative, has it not? Because it's family money, it's legacy money. You don't want to squander that. What does it say, though, when a lot of this money is moving away from fixed income and into alternatives, as you suggest, which potentially, yes, could be a diversifier, could mitigate volatility and provide diversification as well, but also potentially means much higher risk?
Potentially, but I think we need to keep in mind that the movement of the money will take time. When we did the survey earlier this year, we asked these family offices how they will allocate money over the next 5 years. So this is a longer term trend. So most of them still own about 15 to 20% in fixed income. The trend is that they will gradually reduce the exposure to fixed income, but move some of that money to PE, private credit, and so on and so forth. Yes, potentially the risks can be a little bit higher, but the trend is very clear. They are going to reduce some of that liquidity in return for higher return potential over time.